Welcome to our viewers. My name is Joe Halwax, Managing Director of Institutional Investment Services at Wespath, and I'm joined by our Chief Investment Officer, Dave Zellner. We're here to talk about recent stock market volatility, its causes, and how long this might last.
Thanks, Joe. It's good to be here. I'm looking forward to our discussion.
So Dave, this last week, the stock market declined for the 8th straight week. And it's the first time this has happened since 1932, so 90 years. There's a lot of talk now about a bear market. So can you tell our viewers what defines a bear market, how often they occur, and how often they normally last?
So generally, Joe, a bear market occurs when the stock market experiences a decline of more than 20% from its most recent high. The NASDAQ actually fell into bear market territory on May 5th and is down about 30% through last Friday, May 20th. Several other stock indexes are also down more than 20%. However, the investment community considers the S&P 500 index as the official bellwether for U.S. stocks. It peaked on January 3rd and hasn't quite broached the 20% mark based on end-of-day prices. At least that was the case through last Friday. Now, the most recent bear market occurred just 2 years ago at the onset of the pandemic. At that time, the S&P 500 fell 34%. But then it rebounded to surpass its prior highs in just 33 days. And that was probably the shortest bear market in history. That rebound completely caught investors off guard, as the consensus view at the time was that we were in for a prolonged and agonizing recession. So in the last 60 years, Joe, we've experienced 9 bear markets. Our viewers can see now a chart that shows the magnitude and length of these 9 bear markets. The longest was the period following the tech bubble, which lasted a bit over 2.5 years from March 2000 to October 2002. During that time, stocks fell 47%. The next bear market was 2008 to 2009, when the housing bubble burst and stocks fell a total of 55%. That was the second worst decline in stocks, surpassed only by the performance of stocks coincident with the Great Depression beginning in 1929. So there's really no standard playbook for bear markets. Some last a long time, and others as little as a few days, as we saw back in 2020.
So that's some good history, Dave. Can you tell us, what's driving these current stock market losses?
Yeah, Joe, in your blog last month, I think you did a great job describing what is probably the primary reason for market losses. In it, you talked about the persistence of inflation and expectations that the Federal Reserve would take aggressive action to rein in the excessive inflation we've recently seen. I completely agree with your observation that inflation is a headwind for stocks that influence monetary policy, which tightens to fight inflation, resulting in slower economic growth, leading to lower demand for goods and services, eroding corporate profit earnings, and then often leading to job losses. If we look back at the bear market in the early 80s, most attribute its cause to the impact of the Federal Reserve's aggressive actions to address inflation at that time, consistent with what you observed in your blog.
So Dave, can you tell us then about the aggressive action the Fed is taking now, and why is it bad for markets?
So the Fed has several tools in its toolkit to fight inflation. The first is short-term overnight borrowing rates that banks pay the Fed to borrow money. So for most of the last 10 years, the Fed has kept interest rates near zero. And as a reminder to our viewer, the Fed's main goals are to promote full employment and control inflation. Over this time, except for the onset of the pandemic, we've had low unemployment rates. And inflation has pretty much remained below the Fed's 2% inflation target. Now, a second tool is its balance sheet. The Fed can create money, and they use the money they create to buy bonds, primarily issued by the US government. This helps keep longer-term interest rates low. The Fed built a rather substantial balance sheet during the pandemic. It funded much of the trillions of dollars of fiscal stimulus authorized by Congress in response to the economic devastation caused by the pandemic. So when the Fed wishes to fight inflation, it will raise the overnight interest rate that it charges banks to borrow money, and it will sell the bonds it holds on its balance sheet to raise longer-term rates. When it sells bonds, it is increasing the supply of bonds in the market. Our viewers are certainly familiar with the law of supply and demand. When demand goes up, prices generally go up. And when supply goes up, prices generally go down. Bond interest rates rise when prices go down. So now, why is that bad for markets? Higher interest rates discourage companies and individuals from borrowing. When this happens, the economy slows. When the economy slows, generally, inflation declines. Now, the risk, of course, is that the economy slows too much and it enters into a recession. Corporate profits decline in a recession, and lower profits are bad for stocks. Hence, the reason we've seen 8 straight weeks of stock market decline is because investors are uncertain whether the Fed's actions will successfully lower inflation without tipping the economy into recession.
So Dave, you described why we're seeing these losses in the stock market, but bond returns are also down. And looking at the major indexes, down 10% through April. So we've not seen bonds fall this much as we've entered a stock market in some time. So can you explain why is that?
Yeah, Joe, as I mentioned, the Fed has signaled to the market that it will aggressively address inflation by raising interest rates and reducing the securities held on its balance sheet. So these rising interest rates lead to lower bond prices, resulting in negative returns for fixed income investors. The magnitude of expected Fed activity has led to the outside losses in bonds that you cited through the end of April.
So in the blog that I wrote, I noted that the recent correlation between stocks and bonds was positive for the first 4 months of the year, and it's a rare event. And response to the the Fed actions for inflation. But since early May, we've seen that more traditional historical relationship, a negative correlation, reassert itself between stocks and bonds. Can you comment on that?
Sure, Joe. So as we discussed, many investors now fear recession because of anticipated aggressive Fed tightening. The 10-year US Treasury note, which recently peaked at 3.12% on May 6th, has since fallen about 0.4% or 40 basis points. While it's not a surprise that bond prices have risen over the last week or so as stocks have continued to decline, I'm not really sure we can count on bond prices holding at this level unless the Fed can successfully get inflation under control.
So Dave, what happens next in terms of what is Wespath doing with all this uncertainty, or our response to the uncertainty in the markets?
Yeah, so as you know, Joe, we closely monitor the markets and the economy. We have frequent conversations with our asset managers, and they are best positioned to respond to near-term events and managing assets that they steward on behalf of Wespath. They keep us informed about the actions they're taking, and we monitor their portfolios every day. I frequently review various reports and ask our teams questions about our asset managers' activity and performance. Now, in terms of Wespath's overall investment strategy, our participants and clients know that we are disciplined long-term investors. We adhere to our investment beliefs. We recognize that the US and world economies periodically experience setbacks, as we did some 14, 15 years ago with the great financial crisis. We're experiencing a similar situation today as the economy adapts to the disruption caused by the pandemic, exacerbated by Russia's barbaric war in Ukraine. But we have confidence that our collective resilience and adaptability will overcome all of the challenges that we must confront. We believe that the world is on a path of modest and sustainable growth, led by the billions of people in the developing world that are being lifted out of poverty and into the middle class. We can't predict how far stock prices will fall and how long a bear market might last. What we do know is that we do not time the markets. And we know that when bear markets end, they end suddenly and dramatically and reward patient investors. We've adhered to this strategy for many, many years, and it has successfully helped our participants and institutional clients achieve their financial objectives.
So this is certainly one of the most interesting and volatile markets I've seen in recent history. And I should mention that this is why our institutional clients create an investment policy statement. And it's basically a plan, for your asset pools. The plan for each asset pool will include things like the purpose or the goal of the investments, and the liquidity needs and the risk tolerance. And so by having a plan, we're better positioned to avoid making, say, short-sighted decisions or emotional decisions, especially when markets are down. It's also worth noting that one of our longtime managers, Capital Group, wrote a nice paper that on this recent market volatility, and we'll attach it in a link to our website. So thanks for the color on these historical moves, Dave.
Thanks, Joe, and I hope our viewers found our discussion to be informative.